Beimnet Abibi, our friend from Galaxy Digital Trading. Great to have you as always. How are you doing?
Doing great.
Yeah.
How are you doing?
I'm great too. I'm excited.
Beautiful.
This is our year-end episode.
I'm so pumped.
You got a lot of fans out there in podcast land, and normally we sort of keep it a bit tight, right? We say like, what happened last week?
Yeah.
What did Jay Powell say today, etc. But I'm thinking more. I'd love when you look back at this crazy year 2022 in markets, not just crypto, of course, but in macro and everywhere else. I don't know what's your big takeaway. I don't know how to ask this question, but like 2022, speak.
Yeah, no, I mean, this year, I would say that the biggest thing that happened was the cracking of the bond market, basically. The massive shift that you've had from, super easy monetary policy to the complete opposite. I mean, before this year, you were in a 30, 40-year bull market in bonds. And the whole world is long bonds like crazy. And all of a sudden, the Fed jacked up rates to 4-5%. And that had a huge impact on basically everything. The dollar went crazy. You had things like the pound crashing, right? Dollar yen, like forcing a Bank of Japan intervention in their currency market, not just once, but twice. And so it's been a year that I would say where everybody had to reconsider basically every investment on the planet because the opportunity cost of money went sky high. Every investment has to be pegged to interest rates. And when interest rates are 4 or 5%, that means those projects need to be earning a lot more. And so what higher interest rates have caused is just a recalibration of every investment to account for the opportunity cost of money. And that's been pretty transformational.
Yeah.
The other big thing was just the idea of hard assets and commodities, right? Like when you're at war, you really care about getting food and
oil.
And like minor disruptions. And this causes, huge delays in semiconductors. And so, I think, given the Russia-Crimea stuff and kind of the huge moves you had in commodities, I think a lot of investors, have a newfound appreciation for commodities and real-world assets. I mean, just think about it. All of the guys that were about ESG investing this year got wrecked. If you weren't in energy because you were like, it's bad for the environment, well, that meant your returns were lower.
Yeah.
But moving on, so you had that sort of U.S. jacking up rates. They lead the way. The U.S. central bank always leads others, and that basically caused everyone from the Canadians, New Zealand's, EM countries, they all started jacking up their rates, and if they didn't, their currency was going to collapse. And you finally, the last straw or the last thing to drop was the Bank of Japan, and they just did it yesterday. Literally, just to beat the year-end mark, they adjusted their yield curve control policy from 25 basis point cap on 10s to 50. This is the first sort of hawkish shift you had in the BOJ, and they're the last remaining they're still on negative interest rates in the front end.
Yeah.
In a world where their inflation is not only continually going up, but it's actually accelerating in the data.
It's crazy.
And so, yeah, I mean, it's crazy to me because when you juxtapose that with where we were during COVID, which was just like, here's bond buying programs. We're buying $120 billion per month. You had negative interest rate policy priced in the U.S. briefly. That was 2020, but
yeah.
But still, you went from all this easy money, crazy amount of like everything's going up forever, venture investments trading at ridiculous valuations to guys, no, we can't do that. There are issues with just printing money like crazy. And obviously, this deleveraging has impacted crypto as well.
Yeah.
And that's why, largely speaking, the move in interest rates is what's caused the roll in equities and other risk assets, venture investments, et cetera. But yeah, that's the main story. And now, in terms of where we're going from here, it really depends on what inflation does domestically and abroad. Right. There's a path towards a soft landing in the U.S. I think it's very feasible. and that's kind of what the market is pricing in, and what the sort of forecasts that the Fed are providing, sort of price. They're basically saying unemployment is going to get to 4.7, and you're going to see some slowdown in growth, but it's not going to be a collapse. And stocks are trading at fine multiples here. Break-even inflations are telling you you're going to get to within spitting distance of the Fed's inflation target. And so the market's like, yeah, soft landing seems feasible and is the likely outcome that's being priced. And if not to get too granular, but in terms of a hard landing scenario, I think that in my head and in the market's head, which I kind of agree with right now, that's probably like a 20% probability.
Mm-hmm. Wow.
Maybe
25% of a hard landing, and the 75% of a soft landing is how the market is currently viewing it.
Depending on how you look at it.
Yeah.
The way I think about it is like what are like the low delta, or like what's the implied probability that the S&P goes to like 3,300,
right? Or
the implied probability that the Fed cuts by 150 basis points or more, right? So if you look at those markets and look at those option curves and try to bake in or try to extract out like a probability, that's kind of where I'm getting to, like 20%-ish.
Wow, that's extremely bullish, or on the market's view, right? I don't know if it is bullish. I mean, it's optimistic. Let me put it that way.
It is optimistic, and there's a lot of people, you get a lot more headlines being like doomsday, this thing's going.
Oh man, how many people's? First of all, there's been the long-term ones that were, the broken clock has been right twice a day. They've been bearish for, they missed the entire run-up from the last recession until 2021, and then all those guys came back, and then you get a whole new class of these doomsayers.
No, absolutely.
Right? I mean, you also get the crypto fudsters, these guys that come out of the woodwork. They're on Twitter. They use the alarm and the asterisks as if they're like a Bloomberg squawker.
I got to tell you, I mean,
it's a bull market for bearishness.
It is a bull market for bearishness. It's a bull market for FUD.
Yeah, it is.
It is.
Yeah.
And FUD sells.
And you're saying the data doesn't really support that level of
it does not
of negativity.
I mean, like the guy that's saying stuff's going to be fine is not going to be the guy that you're listening to or like clicking the article.
Yeah.
Guys, things are going to be okay. Chill out.
Yeah.
Like that's not a headline you want to click. But it's kind of shaping up that way here.
That's interesting.
Abroad, the story is
rest of world.
Oh my God, it's so complicated. You have like some places in the Eurozone with like high teens, like low 20s, I think, inflation.
Oof.
And they have like all these weird risks. It's like, who really wants to buy Italian bonds? I'll tell you, nobody but the ECB.
Yeah.
And so it's like, wait, the gilt market exploded when we like took a step back. In Japan, it's like, well, they own 50% of like, basically a ton of their asset markets owned by the BOJ. And it's like, well, if we start shifting, like, what does that do, right?
Yeah.
And the problem is you have just such entrenched behavior that still isn't out of the market, right? Like when you were programmed to think bonds only rally and interest rates stay low forever, and you do all of your financial planning in that current world, like you're not set up yet. Like if you're a 30-year, like if you're an insurance company that's managing 20, 30-year liabilities and you've been doing it for 20, 30 years and you're just like, oh, it's easy, just buy long-dated bonds. Well, no, those things are about to, sell off like crazy, and they're not set up for it.
Entire economies and national economic strategies were based around those assumptions.
Absolutely. I mean, just take the simple bank model.
Yeah.
Take your deposits, pay you next to nothing, and buy super long dated bonds or like much further out the curve. Now, the liability costs you more than what you're generating on the assets, and that's like how you get to be insolvent.
Yeah, that's awful.
Right? And so we have to. There's still parts of the world that have to go through that correction, and then you throw in sort of the commodity super cycle that might not super cycle. That's I don't want to use that. Like lots of guys use paradigm shift like crazy. Like you read about paradigm shifts. That's a big statement. That's a big statement.
But the commodities,
can. I think there's a risk that you get like further sort of upside in a lot of commodities.
A lot of people think this. Smart people like you have said this. Right, even like Zoltan, right, has been talking about the
big one. The big headline that was is Jeffrey Curry at Goldman. He's their commodities analyst. He was really good early in the year last year, super bullish oil.
And he was pulling, 43% appreciation in commodities?
Yeah.
In 2023 is his prediction.
That's his prediction. And you know what? There's a healthy two-way risk to that prediction, but I am inclined to think that that number sounds feasible to me. Think about this. A quarter or a fifth of humanity is about to reopen.
Yeah.
There's literally 1.3 billion people that have been trapped at home.
In China.
Yeah. Not doing anything and saving money and working.
Are they really going to reopen, though? Haven't we heard this?
Everything points that way. Now it's like...
Now it is?
Yeah.
Now it's
it's happening.
Got it.
And once you let the genie out the bottle,
Well, I agree.
Right? And you remember in the U.S., when we reopened, it was
reopened,
gangbusters.
And they said masks off, and now it's like, nope, there's nothing they could do. I
mean, they would have people partying in the streets.
Yeah, I mean, they would have to really, really go hard to actually put us back down, right? I mean, it would take a lot.
I mean, think about it.
It would literally take police on the street.
Imagine Chinese people were protesting like crazy.
They were.
And it was hitting the media, and that's the big risk if you're, in the Communist Party, etc. And so when you have a fifth of humanity about to go crazy after saving a bunch of money,
buy stuff,
travel, ride cars, goods, I mean, that's going to put some upward pressure on commodities, most likely.
Yep.
Right? And then the question is, okay, well, if oil starts to go crazy again, does inflation in the U.S. come back? And then it's like, holy shit.
It's a big part of the CPI, right?
Yeah, well, yeah. If you're looking at I mean, I don't even know why they strip out energy. People spend money on gas. I care about how much money I spend on gas.
Me too. Yeah.
Right? And it feeds into all the other goods and stuff. And it's like, core CPI.
Oh man,
so nonsense.
So
it's
this
like
is
a legacy
big,
number.
This is sort of a big, I don't know what the word is, but sort of question mark. Then how the China reopening actually affects. I mean, thrown out one, right? The commodity upward pressure on commodities prices is one, but also the ripple effects. It could affect the supply chain again if all of a sudden they need to get a ton of stuff in by boat or out by boat, right? The whole big question mark for how that impacts 23.
Absolutely.
Yeah.
But all I know for sure is that interest rates are high. And, if you think about it, you're not really taking risk, right? If you go buy a 6-month T-bill and earn 4.5%, that's 4.5% that you're making without taking any risk.
So the risk to Treasury specifically, right, is a U.S. default.
Yeah.
So when we say when you and everyone else says that treasuries are risk-free, it's because what? Has that ever happened?
It's really because the Fed can just buy them.
Yeah.
Just print money.
Well, because the risk is so low because we have our own money printer.
Yes, basically. Yeah. Well, it's because U.S. is the dominant sort of monetary system in the world.
Right.
But it's also, if you're worried, you don't even have to go that far out in duration.
Right.
Right?
You can
buy a short-dated one.
Yeah.
And you're not taking any term risk. You'll get the money back in 6 months. And we're just talking about the U.S. credit. If you go up the credit stack of corporate or,
Munis
and you get more yields or mortgage, AAA CLOs.
It just makes it really hard for getting your returns out of risk asset appreciation.
Yeah.
When you can put stuff in very low risk stuff that just pays you money.
Yeah.
That's the whole
the
thing
risk
that's
adjusted returns don't make investing in a crazy tech company like that worth it right now. I don't see it.
So how long does this last though? Is it until rates come down or is it until they stabilize at a level? What is?
I mean, here's the thing. I mean, here's the risk to the risk assets. Essentially, the Fed's telling you they're going to go higher for longer, right? And they want to keep rates high. And let's just say the Fed realizes they can keep rates high and shit's fine. Yeah. People don't go crazy. Unemployment doesn't go crazy.
If that happens,
right? And what you're sacrificing is really a little bit of growth up front. The question is, are you sacrificing big picture, long-term, huge productivity gains by having front-end rates so high and the cost of money so high for a really long period of time? Right? So
basically,
that's the balance.
So you're saying we lose out on the investment in new technologies that will yield huge benefit years in the future? Is that the idea?
I mean, that's a pretty big thing.
That's a risk.
The reason, fundamentally, I was having a debate on the desk about U.S. dominance, right? And, why U.S. dominance is going to continue. People can point to, we got nukes, we got aircraft carriers, we have the Federal Reserve, like the SWIFT system, et cetera. But really, for me, you know what it comes down to? Silicon Valley. We got the best tech, the best brains, and, you pull tons of talent together and you build cool stuff that everyone on the planet uses, right? That ability to innovate your way into growth and revenues, right? Like Apple is basically a giant country. Right? And how did that come about? That comes from a capital market and capital formation, and that's aided by low interest rates and deeply hindered by high ones.
I see.
And
that's very interesting.
Right? And so that's not necessarily how the Fed thinks about it, but that's how I think about it.
That's a risk. That's
a risk. It's like, who wants to
And it's not that it goes away, but it's sort of like, how much do we lose a period of time, right? While we're not.
Like, if I'm a big money manager, it's like, am I going to throw money into venture, especially in the kind of year that
venture
has this year? No, dude, stick it in bonds.
Yeah.
Take no risk.
And that means fewer companies getting founded, fewer entrepreneurs, right?
That's all.
Growing more
just
slowly.
Think about a regular company, Microsoft. They always have an investment. Do I invest in research and development, or do I
do my core thing?
Do I just return money to my shareholders, or do I buy back my own debt? There's so many.
And it's hard if you are looking at that question and you've got, let's say, I forget, Harvard Business School calls it the golden ratio. I forget what it is. Maybe it's 15%. They suggest that every mature company should be investing in R&D, right? And disrupting themselves. But it's if you've got to cut a bunch of money, right, or cut back on your OpEx, it looks like something you might not need. A nice to have, perhaps not a need to have. But that has a long-term effect, perhaps, on discoveries not being made, new science not being developed, et cetera. So that's a really interesting side effect I hadn't thought about of high front-end rates.
Absolutely. And it's also, I don't know. I feel like I don't need to learn to code right now. Have you seen this thing?
It's so funny. I haven't seen. Is this a meme now that you don't need it? Because it used to be from 2010 to 2020, every kid, who says, well, what should I major in? You were like, engineering.
Yeah, and now I'm
development.
Learn how to use this thing.
Yeah. Can ChatGPT code for us? It's a good question.
Yeah, absolutely.
Yeah.
Yes.
All right. Well, this has been a fun conversation. A little longer than
I could go for hours.
I know.
Honestly,
I know, but we got a bunch of other people to get to. So thank you, Beimnet Abibi from Galaxy Digital Trading, as always, my friend, and have a great holiday and New Year.
You too.
If you liked our conversation with Beimnet, recall that it's part of our weekly podcast, Galaxy Brains, which you can listen to everywhere on every platform, and check out all the links are at galaxybrains.io.